Hello everyone, in this video we discuss openness in goods markets. But it's actually our first chapter on, or our first section on an open economy, so we'll also start in general with an introduction to what this is all going to be about. So to put it into the big picture, so far we've always assumed that the economy is closed, so it's not interacting at all with the rest of the world. And the reason for doing that was not that it is realistic, but that it allows us to keep things simple and obtain some basic macroeconomic insights. And now that we have accomplished that, now as an extension, we open up the economy, because for many policy issues that we see in the real world, that is going to be, of course, quite important. So we're starting with openness in the goods market. But since this is the first part of chapter 18, we'll also do a more general introduction to chapter 18. But before jumping into that, here's just a picture that the book is presenting to make the case that the assumption of a closed economy is, of course, not realistic. What is shown here is growth in advanced and emerging economies since 2000. So actually also we see the growth rate of the world economy since 2000 until 2018. So what we have here in the middle is then actually the financial crisis that we already discussed. And the important thing about the financial crisis is that it originated in the US, but what we see clearly in this picture is that it turned into a worldwide recession. So it spilled over to other countries, and the reason that happened is that the other economies are open, and so then if something happens, the US is open as well. So if something happens in the US, it also impacts the rest of the world. Now, what different types of openness are there? There's not only one way in which economies are open, there are actually three dimensions to it. There's openness in goods markets. So that is about the choice of consumers and firms between domestic and foreign goods. So it's related to imports and exports. And that is something also in terms of economic policy and whether there are restrictions on that. That's where tariffs come in, or another thing where basically importers have to pay something to the government if they import. There are also restrictions like quotas, and even fairly open economies that are actually allowing quite a lot of trade, they typically will still have some tariffs and quotas on something. And then more recently with Trump's tariffs, of course, this has been becoming a very big issue again. The second type of openness is in financial markets. That is about the choice of financial investors between domestic and foreign assets. So, for example, somebody in Europe could decide to buy American bonds. That is not a good that is being bought here, that's a financial asset. And there are also restrictions on that. So it used to be the case that often domestic residents, also in European countries, were quite restricted in what type of foreign assets they could hold. And this type of restrictions is called capital controls. These type of controls have been in recent decades gradually removed, and so capital markets have become more integrated over time. And then the third type of openness is openness in factor markets, and that is first about the ability of firms to choose where to locate their production, but also about the choice of workers where to work, so migration. Now, what we'll be focusing on when we discuss open economies will be more the short run and the medium run. And for that, the goods markets and the financial markets are going to be the most important. So we're not going to really look at openness in factor markets very much. When we were looking at the short and medium run, we were also mostly focusing on goods and financial markets. So our main task is going to be to extend this analysis to open economies. Then what does chapter 18 do? It starts with a section on openness in goods markets. And then this is about the choice of firms and consumers between domestic and foreign goods. And a key variable that is then playing a role in that decision is what is called the real exchange rate. So we'll have to discuss what that is. Then we're going to look at openness in financial markets. And there, key things that are going to play a role is interest rates and exchange rates. And then there's a concluding section of this chapter that then basically explains how are we going to use these concepts in the next chapters. So this is mostly about some basic concepts. We're not actually building any new models yet in this chapter. So that's basically then what's coming in the following chapters. So now we're jumping into the openness in goods markets. It's about exports and imports. So let's first have a quick look at the data here. So what we're plotting here is, as a percent of GDP, the imports and exports of the EU. And you see that, so as we're starting in 1960 here, it starts out at a relatively low level, around 20% in 1960, and it has increased a lot. Now it's 2014 is the latest in this diagram, and it's about 40%. So in that sense, if we use that as a measure of how open the goods markets are, it has become a lot more open. We can also compare that to the US, that actually has a much smaller fraction of exports as a part of GDP, only about 13%, comparing to 40% for the EU. So a lot smaller. We're going to discuss this a little bit more, why that might be. Looking again at the EU, we see that imports and exports roughly follow the same trend. They kind of increase together. Since 1990, exports have exceeded imports in most years, pretty much in all of the years. You see kind of this gap here. Doesn't look big, but it's about 1% of GDP. Now, if we compare that to the US, it's also very different there. The US has had a trade deficit for the last 30 years. And so then also one of the things that we will try to understand is where might that be coming from, how that might be, how such a trade deficit might also be impacted by macroeconomic policy. So here we're looking at a few more countries. So we already said the United States. This is now for 2017. United States there has exports as a fraction of GDP 12.3%. Japan is actually not that much more. The UK around 30%, so almost 3 times as much as the US. Germany, there it already goes up to 50%. And if we look at the Netherlands, it actually gets quite close to, it's 86, so it gets quite close to 100%. And then at first you might say, well, maybe 100% is the maximum. But conceptually, that's actually not the case, because imports and exports can also include intermediate goods. So if a country is actually importing a lot of intermediate goods and is then just doing a little bit of, adding a little bit of labor to it, just a little bit of value added, and then exporting most of it again, then the GDP of the country is actually, this additional value added that the country is putting, but the exports, the value of the exports also includes the value of these imported intermediates that could be much bigger. So it's very easily possible, theoretically at least, that the exports are 5 times of GDP of a country. That's not the case for the Netherlands, so it's still below the GDP, but there are some countries for which exports are actually larger than the GDP. Then again, looking at the US, it has the smallest number here. Does this mean that the US has a lot of trade restrictions like tariffs? Well, of course, that has been changing recently, but traditionally the US doesn't have actually that many restrictions on trade. And so there are other determinants that are important for whether a country is exporting a big part of its output or not. And those are geography and size. Geography, if a country has a large distance from other markets, then you would export and import less. And that is, for example, one of the reasons why Japan has a relatively low number. What also matters a lot is the size of a country. So the US is huge, and so that actually means that it's big enough to produce pretty much everything. So it doesn't have to specialize in particular areas. Whereas if you think about a country like the Netherlands, it's not possible to produce everything. And so then you specialize in the things that you're especially good at, and then you import and export quite a lot. You import all the rest, and then you sell a lot of the things that you specialize in. Now, thinking more about the US and this low number of 13%, does this mean that the US effectively is a closed economy? Should we really think of this 13% as a good measure of the openness of the US economy? And here's an argument why actually that might not be the case. So even if there's not that much actual importing happening, it could be still the case that most of the US producers are still competing with some foreign producers that produce also goods that could potentially be imported. So even if at the end of the day not that much is imported, the US producers still have to make sure that they remain competitive. And so then another thing to look at would be what fraction of output is actually something that can potentially be traded. So there's some things that cannot be traded that are very difficult to trade, like haircuts, for example. So there you have to show up in person to get your haircut. So services are typically not tradable, but also some goods might be difficult to trade because maybe they might spoil before they get anywhere else. But then what fraction of goods is actually tradable? And for the US, that's about 60%. And so there, in principle, then the producers of those goods, they do compete with other firms. And that might be a better measure of openness, at least from some perspective. All right, so now we're going to jump into this issue of real exchange rates. So we're now going to try to model in the goods market. We're not trying to model it yet, but we're moving in that direction. What variables are going to be important for the decisions here? So the decision that we have focused on so far is just the one between saving and consuming when we were talking about the goods market. But now firms and households also are going to have the choice between domestic and foreign goods. So what does that depend on? Well, here the key determinant is what is called the real exchange rate. What is that? It's the relative price of domestic goods in terms of foreign goods. That's not the exchange rate that you read about in the newspaper. There you read typically about the nominal exchange rate. So what we'll do is we'll first discuss what is the nominal exchange rate and then relate it to the real exchange rate. So nominal exchange rate first. There are two ways of quoting. If we have two countries, or two currencies, there are two ways of quoting the real exchange rate. One way of doing it is as the price of the domestic currency in terms of foreign currency. So if we take the euro area as the domestic economy, then it's the price of a euro in terms of dollars. So like a recent number would have been a $1.16 for that. Or we can do it the other way around as the price of the foreign currency in terms of domestic currency. Then $1 would cost 0.86 euro. If euro costs $1.16, it's just the inverse of that. Both are correct. There's nothing wrong about either one of them. But of course, it would get very confusing if we switch back and forth. And so for consistency, we just stick with the first definition here. So for our purposes in the course, the nominal exchange rate is the price of the domestic currency in terms of the foreign currency. And the variable that we use for that is going to be E. Then there's some terminology related to that. First, where is this nominal exchange rate coming from? It's determined in foreign exchange markets. So that's an important term here. And these markets are trading the foreign exchange continuously. So then also the price is going to move around continuously while the markets are open. Then terms related to that, then what can happen to the exchange rate? One is appreciation of the domestic currency. That's an increase in the price of the domestic currency in terms of foreign currency. And so that is for us going to be an increase in E. And the depreciation is the opposite, a decrease in E. There are related terminologies that you may have heard, although since the euro doesn't have any fixed exchange rate with for example, the dollar, it actually doesn't show up that often anymore. But those terms are devaluation and revaluation. So if a pair of countries has a fixed exchange rate, so that's a system in which two or more countries maintain constant nominal exchange rates between their currencies, so then most of the time, the nominal exchange rate will not change. By definition, it's going to be fixed. But sometimes the countries still decide then that they need to adjust it. And so then there can be a revaluation, which is an increase in the exchange rate under fixed rates. So that is something that by definition of a fixed exchange rate is going to happen infrequently, not like continuously like the appreciation and depreciations. And the devaluation is going to be the opposite. So here for the nominal exchange rate, then what we have in this diagram is the one between the euro and the US. So it's the price of the euro in terms of dollars. And so you see that actually starts in 2000, it runs until 2000. Yeah, well, it's a relatively recent picture that I generated. And so you see that it's moving around quite a lot. For example, the price in terms of dollars of euro was actually quite low in 2002, around 90 cents. And then it actually kind of increased a lot to about 1.5. Then it went down again. And then since then, it has kind of been moving around, still fluctuating quite substantially. And also just recently, since Trump tariffs came into place, the euro has become more expensive again in terms of dollars. Okay, that's the normal exchange rate. So now let's move on to the real exchange rate. So what's the basic idea here? And an example of that idea. So the key idea here is that ultimately what we want to talk about here is the choice between the domestic and the foreign goods. And for that, the nominal rate is not going to be enough, because that just really tells us the relative value of the two currencies. But what is, of course, important for the firms and the consumers is what can they actually buy with a dollar, what can they buy with a euro. So let's run through an example where first we only have one good. And let's try to see what's the real exchange rate in that case. So here, let's assume that both the EU and the UK only produce cheese, so we only have one good to worry about. We also need to have the normal exchange rate here to compute the real exchange rate. So that's going to be that the euro costs 0.8 pounds. So actually, the pound is in that sense relatively worth more compared to a euro. You only have to pay 80 pennies for a euro. And then, but now we also have to see what can you actually buy with it. And here we're going to say 1 kilogram of EU cheese costs 20 euros. And our idea to then make it comparable and to get the relative price, the price of the European cheese in terms of the UK cheese, we convert it into pounds now. So we take it 20 euros times the exchange rate, which is 0.8 pounds per euro, gives us then 16 pounds. And then, of course, for the UK, we just look at what is the cheese there in terms of pounds, and let's say that's that 10. Then we look at the relative price. So 1 kilogram of EU cheese costs 16 pounds divided by 10 pounds, so 1.6 kilogram of UK cheese. So what we're getting here is the price of the EU cheese in terms of UK cheese, and that's 1.6. So you have to give up 1.6 kilogram of UK cheese to get 1 kilogram of EU cheese. That's the idea. So this is already a real exchange rate, but in a simple example where we only have one good. So now we want to extend that to multiple goods. And so then in some sense, we need to have all the prices of stuff that's domestically produced, both in the UK and in the EU. And so, okay, what's that going to be? Well, we already had a concept for that, and that's precisely the GDP deflator, which is an index for the prices of all the goods that are domestically produced in an economy. So we're going to use that. And so then we're going to get a formula which is going to look like this. Let's derive it step by step for the real exchange rate. So this epsilon is going to be the real exchange rate. We have the GDP deflators, so P for the EU, P star. So the convention is foreign variables are always going to have a star. We also have our nominal exchange rate here. Okay, so why is it this formula, precise formula? In some sense, it's similar to what we already had on the previous slide. So the price of the European goods in euros is P. Then we convert this, exactly what we did before, into euros by multiplying it with the normal exchange rate. So we have something in euros, and then we're going to multiply it by pounds per euro, the normal exchange rate, and then we have it in pounds. Then we take our UK goods, P star, that's the price of the UK goods, and then we're, similar to what we did to the previous slide, we just divide it. And then we have our real exchange rate, epsilon, which is EP divided by P star. One caveat though, I mean, before we got something very concrete. For cheese, it was, you had to give up 1.6 kilograms of cheese for 1 kilogram of EU cheese. Now, once we switch to GDP deflators, actually the level of a GDP deflator, that doesn't have any meaning. Only the rate of change in it has a meaning because they are normalized to 1 in a base year. So saying that the real exchange rate is 5 or something like that doesn't really mean anything. That's uninformative. But the change in the real exchange rate is informative. An increase in the real exchange rate by 10% means that European goods have become 10% more expensive relative to UK goods. And then there's some terminology related to that. A real appreciation is an increase in the real exchange rate, and a real depreciation is the opposite of that. So here in this picture, we have both the real and the normal exchange rate between the euro area and the UK since 1981. And so two observations here. So in principle, it's possible that they also move in opposite directions in a given year. So we have one example here. So here we have an increase and a decrease. So a decrease in the real, an increase in the nominal. So that can potentially happen, but it doesn't happen all that often. One has to look for that a little bit. Also, over longer time horizons, although that doesn't really seem to be happening here, they can diverge quite a bit, the nominal and the real. And that will happen. So we have, what's the formula? Epsilon is equal to EP divided by P star. And if a country has a lot of inflation, more than the other countries, so suppose Europe has more inflation, then the P would tend to go up. But then, of course, the euro would lose value in the foreign exchange market. It would depreciate, and that goes down. So maybe not that much will actually then happen to the real exchange rate, because prices go up, but the exchange rate goes down. But of course, the E is moving a lot. So then there would be a divergence between the two. That can happen if the inflation rates are different. Here, both the UK and the EU, they try to keep the inflation rate close to 2%. So then this doesn't really happen here all that much. And then the next important observation is that from year to year, the movements in the real exchange rate are actually mostly coming from the movements in E. And that is because in the foreign exchange market, the E can move around a lot. We already saw that. Whereas the price levels, P and P star, they tend to change relatively slowly most of the time. So this is just the real exchange rate between two countries. But if we want to assess the overall situation, are European goods or euro area goods, are they expensive or cheap relative to other goods? Well, for that, we want to then ideally have a number that captures for the euro area overall across all the different countries that it's trading with, competing with, what is the real exchange rate. And so that's the last thing that we'll do with respect to the real exchange rate. And so then let's look at this from the perspective of the euro area and try to figure out what we could pick here. And then for that, we first have a look at whom is the EU actually trading with. And we see that it's mostly like a big group. There are three big groups here. European Union countries which are not part of the euro area, then Asia, and then also the US. Those are kind of the main thing, both for exports and for imports as well. And now the idea is, okay, what we could do is we could use these trade relationships to basically average. We have for each country, we can come up with a real exchange rate, and we can just average this basically. Maybe in reality what you do is a little bit more complicated, but roughly the idea would be to kind of average this, weighting it with the importance of the trade with these other countries. In practice, it's done in a somewhat more complicated way. So it's a weighted average using both kind of how much you trade with the euro area, but also how much the EU competes with other economies in third markets. So it could be that maybe we don't trade that much with another economy, but we're selling cars to another economy, and another economy is also selling cars to them. And so we're competing with them in other markets. So that is also taken into account. So the practical construction of multilateral exchange rate is actually quite complicated, although the conceptual idea is not. You just want to have an average of the real exchange rate, kind of taking into account, how much you compete, how much you trade with these other economies. And so then here we can have a look at, for the euro area, we have one that is called the real broad effective exchange rate. And you see that that also moves around quite a lot. So for example, starting in 2000, there was quite a lot of real appreciation. Then it went down again, and since then it has kind of been fluctuating around. So we also see quite a lot of important movements in how expensive the euro area goods are relative to foreign goods, which is then going to feed into the decisions of the households and the firms, and is going to impact demand for domestic goods, etc. So that's then what we're going to be discussing later.